early to the weekend. You're opening bell about 22 seconds away on the S&P 500. There's a lift here on the S&P by 0.75%, attempting to end this month, this quarter, this week on a high. The Nasdaq 100 up by almost 1 full percentage point. Going into Friday, it's down on the week, it's down on the month, it's down on the quarter. There's your opening bell. Switch to the board and get to the bond market. Yields look like this. Yields are down on the session. They are up big time on the month. We're down 5 basis points, 451.79 after having a little look at 470 yesterday and about 468 at the height of session yesterday intraday. In the FX market, the euro trying to make a comeback. What a week it's been for the single currency. Had a look at 104, had a sneak peek at 106, came all the way back down to 105.88. That currency pair firmer on the session, up by 0.2%. That's a stronger euro, a weaker dollar. And crude 95 intraday yesterday, backing away from that level. Eventually 92 at the moment, up on the day by about 36 cents, up by 0.4%. 30 seconds into the session, state of play. It looks like this, up 0.75% on the S&P, on the Nasdaq up by 1 full percentage point. One stock to watch at the open is Carnival, the cruise line company, reporting third quarter revenue that hit an all-time high. The company's CEO saying, quote, "I continue to be encouraged with our revenue trajectory heading into next year as we see no signs of slowing from consumers." Abby had this one. Hey, Abby.
Oh, well, John, this stock is all over the map. Now, going into the report, the stock had been higher then, initially up 8%, then very quickly down 5%, right now up about 3%. So let's take you through some of these headlines. So for the quarter that they just report, they did beat estimates for earnings. They came in stronger. On a year-over-year basis, last year it was a big loss of about 65 cents. GAAP earnings this year, 79 cents. So much improvement there. Revenues were a little bit higher as well. They're also talking about bookings for 2024 being locked in. But what had the stock down initially or momentarily was the fact that they're now seeing a fourth quarter earnings guide of a loss of 18 cents to 10 cents, or I should put that 10 cents to 18 cents. The consensus is at a loss of 10 cents. So it seems as though investors, though, are working through what this could mean. And they're also, on an adjusted basis, talking about 4 cents to 12 cents. The consensus was at 16 cents. So I think that that's probably what has the stock higher. We'll be working through these numbers, and we now have at least Royal Caribbean. I haven't taken a look at Norwegian yet, trading up in sympathy, but it seems as though the cruise industry, a little perplexing to me, going strong.
You and I both, Abby, thank you. Their stock is up by about 4% at the moment in early trading. A decent move for that name. If you want a bigger move, look to Nike. That stock up by close to 8%. Shares rising there after the company beat profit estimates and saw a bigger than expected drop in inventory. The CFO saying this: "We're very comfortable with the level of inventory in the marketplace in relation to the retail sales we're seeing." Simone Foxman on top of this one. Hey, Simone.
Hey, John. Yeah, and this end of this inventory glut seeming to be the end of discounting pattern that we have seen in the stock, and that's why Morgan Stanley is saying a bottom may be behind the company. Despite this now 7.5% jump today, we're looking at shares down over 17% year to date. So the reaction to a better than feared set of earnings coming in here. Overall revenue actually underperforming slightly, up 2% year on year, but there were signs that the U.S. consumer may not be as pressured as everyone had feared. North America accounts for about 42% of the company's business, and same-store sales falling 1%. They had been seen to be falling more than that. Europe also exceeding expectations. The concern, however, China underperforming in same-store sales, still up 12% year on year, but most expectations had been for over 15%. Jefferies analyst Randall Kotick telling us yesterday he is very concerned about the potential for China volatility, as well as some market share losses on the fringe, especially in running shoes. But the emphasis on cost cuts, margins that were better than expected, part of what's driving the surge in Nike shares today, the most since December.
There we go. Simone, thank you. The stock is up by about 8%, 7.6% right now. To Simone's point, it's all relative to expectations, and after what we saw with Dick's Sporting Goods and Foot Locker, that wasn't great at all. This is better. Jefferies aren't alone. This came from BMO today. BMO Capital lowering its price target on the stock to 110 from 120, citing growing concerns about the Chinese and North American markets. That's the concern. The stock this morning is higher by 8%. Let's turn to tech. Bloomberg reporting Microsoft discussed selling Bing to Apple in a deal that would have replaced Google as the default iPhone search engine. Ed Ludlow, how about this one?
Yeah, it's interesting, Jonathan. Apple up 0.7%. It had been up in the region of 1% in the early minutes of Friday's session. Do we draw a causal link with the Bloomberg reporting and the share move higher on Apple and Microsoft? Probably not. But according to Bloomberg sources, in 2020, Microsoft execs met with Eddie Q, who's Apple's services chief. They had early stage talks for Apple to acquire Bing, Microsoft's search engine, and make it the default search engine on iPhone. Those talks were exploratory. They never reached an advanced stage. And of course, Google remains the default search on the iPhone. But the point here is that in the background, the trial is ongoing between the Department of Justice and Google over dominance of its search product. Apple and Google, the parent company now known as Alphabet, have had a search deal in place since 2002. It started with the browser for Mac and it has expanded to other devices. And as we have learned through the course of this trial, this is a piece of business for Apple that ranges from $4 to $7 billion annually in what Google pays Apple to have its Google search engine prominent on Apple's device base. When Eddie Q, the Apple services chief, gave his testimony in recent days about Google's search dominance, he basically explained that Apple and iPhone use Google because it's the best product. So this is a backward-looking piece of Bloomberg reporting. The stocks are notably higher in a market that's up 1%, I think you said, on the NASDAQ 100, John.
Yeah.
But goodness, imagine if that had gone through.
Well, it's one for the history books, maybe. And I do wonder whether the AI frenzy that's happened since changes the prospect of anything happening ever again.
Yeah, it's interesting. You know, lots of hypotheses have been put forward broadly on M&A, whether Apple would actually be able to do anything in this environment under Lina Khan's FTC. But, you know, Apple has kept quiet on the AI front in terms of a generative AI tool, consumer-facing generative AI tool or chatbot, but they've really talked up their history and competence in machine learning and AI. So I think it's interesting insofar as that, you know, Google hopes to maintain a lead in search. And the point with Bing is that it would have been a competitor. AI is now very relevant to the search market, but Bing remains only 10% of it. So it is very backward looking, and it is a what might have been, but it also gives you a kind of lens into what Apple thinks about when it does think about M&A and when it does think about being competitive itself.
Interesting. Looking forward to the programme. As always, Ed, a little bit later, midday, noon Eastern. Ed Ludlow, Caroline Hyde on Bloomberg Technology. We're about 7 minutes into this session. We're positive still, up by 0.6% on the S&P. As Ed mentioned, we're still higher by about 1% on the NASDAQ. Let's look at food delivery services. Uber, DoorDash losing a challenge to a New York City rule mandating an hourly rate of at least $17.96 for delivery workers. Uber saying the law will put thousands of New Yorkers out of work, and DoorDash saying, quote, extreme pay rate will reduce opportunity and increase costs for all New Yorkers. Katie Greifeld on top of this one. Hey, Katie.
Hey, John. Yeah, we're talking about the likes of Uber, DoorDash, Grubhub, etc. Like you said, they now must pay their food delivery workers at least $17.96 an hour. Of course, that's thanks to that Thursday's decision from the New York State Supreme Court. So either the companies must pay that flat hourly rate or pay per delivery at about 50 cents a minute. And as you can imagine, the pushback from the companies was immediate. As you walked through, Uber saying in a statement on Thursday that this law will put thousands of New Yorkers out of work and force the remaining couriers to compete against each other to deliver orders faster. DoorDash said that it's evaluating its legal options and that this is a deeply disappointing outcome for delivery workers, merchants, and customers alike, and saying too that this, quote, extreme pay rate will raise costs for all. So it sounds like the company plans to pass on those higher costs to its customers. But as you can see, the shares of both companies, both Uber and DoorDash, a little bit higher this morning. It sounds like we'll be hearing about this on the earnings calls to come.
Katie, thank you. Appreciate the update. Higher across the board at the moment. Seemingly the story up for a third consecutive day on the S&P 500. Interestingly, if we close here on the S&P for a third day of gains, that's the longest winning streak daily of the month so far, for the month of September as we close out this month and look ahead to October. Stocks rebounding then to start the last trading day of the quarter as dovish comments from Fed policymakers ease some fears of further rate hikes. Kate Moore of BlackRock weighing in saying, quote, the dominance of services in the US economy makes it much less sensitive to higher interest rates than during previous hiking cycles. Kate, I'm pleased to say, joins us right now. Kate, always wonderful to catch up with you. A good friend of mine in a bow tie always talks about companies adapting and adjusting, and I noticed that same line in your notes too. Katie, we're underestimating maybe what they can do in the quarters to come and perhaps overestimating the importance of what's developing in the bond market.
Yeah, I mean, John, I think this is a major theme, and it's been a major theme for well over a decade, I would say, since post-GFC. Companies have been fast to adopt to changing conditions, whether that's higher policy rates, lower liquidity, changes in consumer preferences, changes in geopolitics or policy. And it just really boggles the mind that people continue to believe that companies will not adapt and change. We need to start giving, especially U.S. corporates, a little bit of credit here. And I think one of the major themes we've seen this year from some of the companies that have outperformed the broader market is they took some of the pain. You know, after share price declines last year, they cut costs. They took their foot off the accelerator in parts of the businesses that were, frankly, not going to generate a lot of growth. And they really streamlined what they needed to in terms of their operations to deliver better results. So I am a big believer in the flexibility and the adaptability, especially of U.S. companies, and I would not count them out.
Okay, can you say the same thing about financials, about the banks, given their experience this year?
I think financials, John, I know why you're asking me this, are a very different cat altogether. There's a different regulatory environment, there's a different demand environment, there's a different rates environment. I would say financials are a more challenging sector to put a lot of money behind at this moment. And I think you have to be very selective in the names that you choose.
We talked about the relevance of yields to profits, interest rates, to what's happening in corporate America. Can we talk about that with regards to the financials, Kate, with a little bit more detail if you can? Are yields and higher yields good or bad for financials? Because you and I have talked for a long, long time, for the best part of a decade together, and we'd sit here and talk about the relationship between the 10-year and where financials and stocks are priced. And Kate, where's that relationship now?
You know, it's as you know, and this is why you're asking this question, it's much more complicated. And the problem is, John, is, you know, you used to be able to look not just maybe at the whole banking system, but at segments of the banking system and say, you know, this group is particularly interest rate sensitive. This group is going to see net interest income and margins expand in this environment, and this one is going to suffer. But it's not quite so clear as banks have changed their operations. They've shed assets as they have, become a little bit less sensitive in some cases or less adaptable to changing interest rates environments. Not everyone is benefiting from higher policy rates. We, of course, are seeing a ton of money, as we know, flow into money market funds and people sitting on their hands there. So there's an opportunity as banks have kind of taken in, more deposits, and then their wealth management sides have seen inflows into money market. But it's not a one-size-fits-all trade, and this is why I'm saying we have to really choose our names here.
Let's choose a sector. Energy. Mark Haefele, UBS, earlier this morning, surveillance with Tom, Lisa and I, saying he likes energy. Mike Wilson, Morgan Stanley, earlier this week saying the same thing. Kate, where are you on energy names on the S&P 500?
Yeah, I mean, and I heard Dan Suzuki speak a little while ago earlier, before the open. I agree with all of them that there are opportunities within energy, but I think we need to be realistic about it and say, even if some of these companies start generating kind of larger profits because of higher oil prices or because they continue to exert capital discipline, which has been really good for their overall sustainable profit story, there are significant headwinds on the energy side. If there are changes in demand, and we know demand has been quite strong, and that's been a major force underpinning the rise in oil prices. If there are changes in demand because economic activity slows, I think we'll see a quick reaction in a lot of these stocks. So I think you have to be more tactical in this sector. It is not a buy it, set it, and forget it. And I think you want to really stay up in quality.
Does a buy and forget it exist right now, Kate, for you and the team?
I mean, no. I mean, I think this is an environment, a market environment in general, where being more tactical and being on your toes is necessary. And I think that is going to be a dominant theme going into year end. We have all of these cross currents. You guys were just talking about stuff going on in the consumer. Some companies reporting actually fairly good activity, others reporting very weak activity, particularly from low-end consumer. And we can't just make one blanket statement around the sector or around the market. So yes, I think you have to stay on your toes, be more tactical, and spend your longer term research hours on the big themes, but understand that you're going to have to trade around them in the near term.
Kate, it's been way too long. Let's do this again soon. Kay Moore, thank you from BlackRock on the latest view from the BlackRock desk on the equity market at the moment. About 14 minutes into the session, a better stock market on the day relative to what we've seen over the month and a quarter. On the S&P 500 up by 0.6%, on the Nasdaq up by 1 full percentage point. Coming up, pressure building as another UAW strike deadline approaches.
This week, we've received some shocking reports of violence against our members on the picket lines. We condemn this violence that GM and Stellantis are enabling. These attacks on our members exercising their constitutional rights to strike and picket will not be tolerated.
Team coverage up next.
This week, We've received some shocking reports of violence against our members on the picket lines. We condemn this violence that GM and Stellantis are enabling. These attacks on our members exercising their constitutional rights to strike and picket will not be tolerated. Let me be clear. Fighting for economic and social justice isn't a crime. It's our civic duty.
Tensions rising on UAW picket lines as the strike hits its 2-week mark. Union President Shawn Fain calling out GM and Stellantis for alleged violence. Automakers pushing back, GM calling Fain's remarks inflammatory. Stellantis saying, quote, "The companies are not the enemy. We are not at war." At 10 a.m. Fain is expected to announce another round of strikes starting at noon if automakers don't budge. And this time, Ford won't be spared. Union pay raise demands sliding down to about 30% based on our reporting, with counter-offers remaining at around 20%. Let's get to the team coverage. Bloomberg's Anne-Marie in Washington, D.C., the brilliant Shelley Banjo here in New York. Shelley, first to you. How wide is the spread between automakers and this union right now beyond just what is offered on pay?
So they came out saying we want 40% or north of 40%. The car companies came out with 20%. Our reporting this week revealed that a palatable number, a key target, would be that 30% number, that the unions could feel confident in, that they could really get, really come back and bring that back to their members as a win. But there's so many other issues. There's things like pensions and job security and temp workers, and there's a number of issues at the bargaining table, not just that top line pay number.
Shelley, Ford out of the firing line from some of those more prominent comments we cited just moments ago. Are they in the firing line in about 10 minutes time?
That's what we're going to see in just a few minutes to see if they name another Ford plant. What happened last week was they said, okay, we're seeing some progress at the bargaining table from Ford, so we're going to spare them. But they didn't stop the strike that they had already going at the first Ford plant. So this whole strategy is around flexibility to show publicly respond publicly what the progress is at the bargaining table.
AMH has been quite a week, hasn't it, with the President of the United States at the epicenter of a lot of this stuff.
That's right, Jonathan. The first time ever you see a president go to the picket line, voicing his support, going beyond really just putting his thumb on the scale towards the union workers. And yesterday he tweeted that they should stick with it. And in this tweet, Jonathan, you see a video of the president, and there's one line that really struck out to me. He says, "We save them," meaning the big three. "It's about time for them to step up for us." And what is so delicate at this moment right now, Jonathan, for the White House is that potentially we're going to see expansion of these strikes as we just heard. On top of that, we are less than 48 hours from a government shutdown. And if you include $100 for a barrel of oil, that is the difference between a recession or not, according to Bloomberg Economics.
Amazing. AMH, Shelley Banjo, thanks for the update, guys. Appreciate it, as always. The big debate continues. Are those strikes going to be extended, prolonged, deepened? We're going to find out potentially in about 9 minutes' time when we get that UAW news conference, if we can call it that Facebook Live event taking place at 10 a.m. Eastern Time. The broader market going into all of this is doing okay. 8 minutes away, or rather 8 minutes away from that happening. 22 minutes into this session. Equities are up here by 0.6% on the S&P. The Nasdaq higher by more than 1%. Abby has the sector price action. Hey, Abby.
Hey, John, and it's solid sector action. Actually more robust, I would say, than the overall gain of about up 0.6% for the S&P 500. In other words, risk on. You have discretionary, tech, real estate, and utilities all up more than 1%. These are some of the most rate-sensitive sectors. So right now, getting a bid to the downside has been this quarter's big winner. Down 1% is energy. Let's turn right to the quarter because we are, of course, looking at the best quarter, the worst quarter in a year since this quarter last year. Energy up 13%, the one of three sectors that's higher, the most since December of last year. Utilities, John, down 8.1% as those dividends look less attractive. That's the worst quarter since March of 2020. And then we also have real estate, also a dividend-sensitive sector, along with commercial real estate issues, down 8.4%, the worst sector in a year. So quite a bit of drama this quarter. Let's see what the fourth quarter brings.
This has not been a September to remember for good reasons, that's for sure. Abby, thank you. About 23 minutes into the session then, equities higher on the S&P and on the Nasdaq as well. The potential for a third day of gains. Your trading diary up next. 25 minutes into the session, equities higher for a third consecutive day. A three-day winning streak on the S&P, the longest winning streak of September so far as we close out this month and go into October. We're facing the potential of a fourth week of losses on the S&P 500 with this move now just about positive on the week over the previous 4 days, including early this morning. The S&P higher by 0.6%. That's the price action. Let's get to the trading diary. The week ahead, the day ahead looks like this. You missed consumer sentiment at the top of the hour. Plus, UAW President Sean Fain making an announcement on Facebook Live. Saturday, the government shutdown deadline coming at midnight. Tuesday, FTX co-founder Sam Bankman-Fried's sweeping fraud trial begins. And Friday, the September payrolls report, which could well be delayed, if Congress fails to fund the government. From New York City, that does it for me. Thank you very much for choosing Bloomberg TV. And as always, good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day, Friday, September 28th. Here are the top market stories we're following for you at this hour. New York on flood watch. We are bracing for as much as 4 inches of rain, flooding, major travel disruption. It's really a perfect way to end a very rough third quarter. So speaking of, is a fourth quarter storm coming? The 10-year jumped 70 basis points in the third quarter. The dollar hits its highest level in a year, and oil surges over 30%. We're going to see how to brace for the next 3 months. And the U.S. keeps spending. Income and spending hold up as prices see the smallest monthly rise since 2020. Nike and Carnival jump after earnings. That was also pictures of floods. From New York, I'm Alex Steele with my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. That was actually a picture near my house.
Okay.
In Brooklyn.
So I hear it's raining in New York.
Okay, he's going to mock me, but this is serious rain. So we're all talking about this in the office in terms of getting home, because Brooklyn is just completely getting decimated right now, and there are like no trains running anywhere. So this is near my house, I should say, and this isn't even the worst of it. Like, you look at Cobble Hill, you look at Gowanus, it's really rough going. I'm going to walk home, I think, which should take me 3 to 4 hours.
I hope you got some decent boots to wear, but I know you have, because of course you would have bought some boots at some point that would be perfect for this weather. Just where they are is a critical question. Alex has a lot of shoes under her desk. I'm not sure that any of them are going to be appropriate for today's weather, but this is something that keeps happening, isn't it? So you think about what we've been through over the last few months. You guys have had smoke, you've had storms, you've had all kinds of weather to deal with. A, are you now with me that the weather is important? And B, something's going on here, right?
Yeah, yes, I am with you that weather is important, and I think you raise a good point in that we're going to have to retrofit buildings in a different way, right? Like, you guys aren't prepped for snow, for example. We're prepped for snow, but we're not prepped for flash floods like this. Our cars are not set up, and the streets and subways are not set up. And then there's also, what do you do with windows in terms of you continue to have wildfires? And I think that is something that every building, every city is going to have to manage.
At least we are one step ahead. We have many words for rain. So we have already at least embraced the rain. It is part of our lives. We have all kinds of words to be very specific about the kind of rain we're seeing. I think you guys just do rain.
Yes, we do.
But maybe that's a lesson you have to learn as well. The different types of rain are important. But this does take us to our question of the day. Q3 was a fairly rough ride, Alex. Q4, is there a storm coming? And I think Q4 is going to be a weird one as well, in as much as you've got all kinds of other things going on. The government shutdown, I think, could be a feature of the landscape here, and I think that's going to be something that we're going to be factoring in, but it's going to be hard to figure out how to factor it in, particularly if we don't have any data. And then there's the issue of the UAW as well. How is that going to impact the US economy? So to try and answer these questions, we bring together the all-star team. They're all still in the office. Mike McKee and Abigail Doolittle. Mike, I'm going to start with you. Let's start off with the macro and kind of figure out how things are going to develop from here. The Q4 looks like it could be quite a difficult call. Q3 was a really bumpy ride, and this massive pickup that we've seen in yields obviously was something that nobody expected, particularly at the long end. But Q4 looks like we could be flying blind.
Absolutely. If the government shuts down and we don't have any government data, we'll get private sector data. We just got some, as a matter of fact, Guy. The University of Michigan sentiment comes in, and with everything that we're facing, guess which way sentiment went? It improved. 68.1 from 67.7. The current conditions improve. Expectations fall a little bit, and both 1-year and 5-year inflation go up a tick to 3.2 and 2.8. Now, what will be interesting is we saw a big decline in the PCE inflation numbers today that would suggest that all things being equal, the Fed may be able to hold off in November. But if they don't have the data because it can't be released or even collected, then what do? They probably hold off because they don't know what to do, and this is where the Hippocratic Oath would come into effect.
Just side note, speaking of rain, Governor Kathy Hochul of New York declares state of emergency for New York City. I'm just pointing that out here.
Does that mean we all go home now?
I don't know. Guy, take over. We're going to go. Abigail, but I think it brings...
Well, you've got to stay. You have to stay.
Actually,
you can't go home. This is the point. I can go home. You can't.
All weekend. Abigail, but to the point of
the turbulence that we saw in the third quarter, typically seasonally, what are we kind of in for the fourth quarter?
So seasonally, the fourth quarter is usually better into the year end. October can kind of be choppy. We've, of course, had some big sell-offs. And speaking of October, there have been some smart market people who have recently made the comparison of 1987 to me. Steve Sosnick of Interactive Brokers, one of my favorite market watchers, has also made comparisons between SPY and 1987. And Steve Sosnick, he actually provided us with a chart for Options Insight a few weeks ago, talking about the fact that this was the last time when we had rates super high. Now, at that time, rates were actually higher, but it's the trajectory of rates going higher with stocks going higher, that idea of something is going to break. Now, we, of course, did see something along those lines back in March with the regional banks. We now have Larry Fink. We have Bill Ackman saying the 10-year is going to go above 10%. Technically, I can make the case very easily that the 10-year yield is going to go above 6%. The S&P 500, the weekly chart, monthly chart's not so good. So I suspect that there could be some pressure ahead.
Are we meant to get a Santa Claus rally, Abigail? Is Santa not going to show this year?
So, well, you know, it's a really interesting, because I like to think about all the different possibilities. So one question is, can we see some serious selling in October, November? Maybe this idea something does break. We, of course, we may not have data, or we may have data. We have the upcoming earnings season. We have the Fed on November 1st. What color will they give? They really seem to be sticking with this trajectory of higher for longer in terms of not wanting to repeat the 1970s. But think back to 2018 or 2011, where there's a big crash and then there is a big bounce off of it. So we could actually see a big move down and then still have that Santa Claus rally. Relative to the government shutdown, the last one, if you recall, it was, I think, December 22nd of 2018 to January 25th of 2019, 35 days into it. That was that 2018 crash, down about 20%. But over that time period, up about 10%, a relief rally. That also happened to be accompanied by Fed Chair Jay Powell's first pivot. Initially, he was trying to hike, and then when the market was crashing, he started to ease off.
Mike, this is a very drastically different situation than that time round. But then to your point about the data, it continues to hold up. And that just does not make sense when you're dealing with, say, maybe a 5% 10-year, and equities that still haven't, it feels like, really reacted to that in the way it should.
Well, part of the problem is we don't know what's going to happen because the data have been so impacted by the pandemic that it's hard to say that this follows any pattern. But what Abigail was talking about from 1997, I go back to that, and Jim Bullard, the former St. Louis Fed president, was talking to me just the other day, and he was saying, you know, back in the 90s, we had 6% 10-year yields, and we had unemployment up around 5 to 6%, and we had GDP of 5 or 6%. So we can grow at those yields. People just aren't used to it. His view was that one of the problems we have is an infrastructure in the bond market built since the great financial crisis for zero rates. Yep. But now that the Fed's getting out of the market of the idea of pushing down on long rates, it's not going to be a surprise that rates go up, and the economy will adapt to that. Now, how fast, I don't know. I don't know if we get a down fourth quarter, but most people in the economics profession now, and certainly everybody at the Fed, think that we're not going to have a recession.
Okay, Mike, I want to throw something else in. The UAW. How big an impact potentially could that strike have, if it were to carry on, have on the fourth quarter?
It could certainly have a big effect on the fourth quarter in a couple of ways. One, a lack of cars as inventories run down, and that would bring down retail sales. It would bring down the ability of the car makers to make money. But if the strike goes on, it's only going to expand given the way they're running it. And that means more and more people have less and less paychecks who are working for these companies, and then it spreads maybe to the suppliers. And so, again, we have a consumer spending problem. It could be an issue if they don't get it settled very soon.
Right, and also what's different about 1997 is we also have a lot of fiscal expansion based on the green energy transition, which we'll also talk about.
And actually, I think I misspoke. 1987.
87.
Oh,
okay.
yeah.
Well, that makes it everything. It changes everything.
Oh, I see.
Yeah.
Okay.
Because that was the trajectory of the rates up. It wasn't so much the level, but it was that they shot higher with stocks.
Well, speaking of the auto strikes, it looks like the UAW is going to strike 3 more Stellantis, GM, and Ford assembly plants. Remember, last week, Ford was exempt because of the progress they were making. Ford is not exempt this go, so the strikes continue then to expand. We'll bring you any headlines as they cross. I'm just taking a look at what the stock price is doing. Ford is dropping like a stone, actually, now down by about 6
0.6%. All right, guys, thanks a lot. We really appreciate you setting us up here. Be safe getting home. Michael McKee and Abigail Doolittle, thank you both very much. Coming up, more on the question of the day, is a Q4 storm coming? And Barry Threadneedle, partner and founder, joins us next. She made it in despite the weather. I'm just going to point that out. This is Bloomberg. We do want to take you now to the news conference with House Speaker Kevin McCarthy, speaking on Capitol Hill, currently speaking about Senator Dianne Feinstein.
The trailblazing of the first woman elected mayor, even coming from a different party, inspired women from both sides of the aisle to seek elected office and to have their voices heard. My deepest condolences to her family, her colleagues, and to her staff. Last night, the House did something none of you sitting here thought we can do. The number of questions I could take from the number of weeks about doing appropriation bills. I told you, don't give up on us, because we're not giving up on the American people. We passed 3 appropriation bills: defense, state, and foreign ops, and homeland security. My biggest question is, I don't understand why the Democrats voted against funding the government. In all, we have 4 appropriation bills done. There's 12 overall to get done. It's the discretionary spending every year that government is supposed to do. We have now in the House passed more than 70% of the discretionary spending on appropriations. Need I remind you, how much has the Senate passed? 0. Not one appropriation bill has passed the Senate. We've done what many have said was impossible. When I became Speaker, I said we're going to change Washington. And we did that by keeping our commitment to restoring regular order. Bills that passed committee in June and July have been open for amendments for months. Struggled with a number of members who wouldn't allow it to come up, but I never gave up. 440 amendments were considered on the floor this week. And for those who are historians, we are the first Republican majority to pass the State and Foreign Ops bill through regular order since 2006. My entire political career as a member of Congress, the Republicans have never been able to do what they just did last night. As we continue to get conservative wins and return to regular order, we actually need a stopgap measure to allow the House to continue to finish its work, to make sure our military gets paid, to make sure our border agents get paid as we finish the job that we're supposed to do. Another reason for the stopgap is to address President Biden's historic failure on the southern border. This is how bad things have gotten under President Biden's watch. In 5 days, there's been more than 50,000 illegal border crossings. Put that in perspective, in just 5 days. That's more than twice as much as the average for the entire month in the last administration. A wide open policy hurts America. We've heard it from Democrat leaders across the country.
That was House Speaker Kevin McCarthy speaking on Capitol Hill as we sort of inch towards a shutdown. Now, guys, it feels like the conversation has gone from will we shut down to then how long will we be shut down for, raising a lot of questions then about economic activity.
And economic data. And at some point, Alex, this will become a market event. And it's the question of when that comes. Could it be the moment where Moody's turns around as the last man standing on this front and downgrades the United States, the last rating agency standing, and downgrades the United States? I'm wondering when the market pays attention. I think the inevitability of the shutdown is now certain. It's how the market reacts that I don't understand yet.
Yep, and then where the budget gets cut from, and sort of when certain agencies get impacted. You were asking about FEMA actually earlier today, and then funnily enough, we have a state of emergency in New York City because of floods, and how that can sort of go on for a bit, but then any sort of new issues, or depending on how long it gets, people that are receiving payments from another disaster from before might not get those payments as readily. So those little details become more evident as we go through the next couple weeks, which appropriately brings us to the question of the day. Is a storm for the fourth quarter coming? It was a very rough third quarter. There's a lot of question marks on the horizon. Not only the government shutdown, we're just hearing also that the UAW auto strikes are going to be expanding for Stellantis, GM, as well as Ford. Let's bring in Ann Berry, Threadneedle partner and founder. Ann, what are we thinking? Fourth quarter storm?
No, I don't think so. I don't think that the storm clouds open, but I do think they gather in Q4, Alex. I think we see that data coming in that's getting everyone more pessimistic, but I don't think things crack till Q1.
Why do they crack? When they do crack, why do they crack, Anne? Great to see you, by the way. Well done for making it in.
Thank you. I would not have missed coming into the studio to hang out with Alex for the world.
Thank you.
So, Guy, I think it's because if you actually look at what's tended to move the market so far, it's when there's been real data that has shown the effect of some of the monetary policy causes, some of the policy causes. We've not seen that more clearly than on the monetary policy side. And so I think a couple of things are going to have to come into fruition over Q4. We will see really what happens to consumer spending when student loans are getting repaid again. We will really see whether another rate hike happens and what the impact is on US demand. We will really see whether the labour market here cracks. That's going to come through, and then I think the reaction comes in Q1.
So if that's the case, putting all of this into context then, do you think that you agree with Larry Fink that we could see 5% on the 10-year? Because it doesn't feel like that's priced in either.
I think we could, and I think that there have been so many surprises, Alex. Markets haven't reacted in the way that historical rules have caused us to expect they might. Data lags have been longer than we've anticipated, so I actually think anything's possible at this moment,
It sounds like what you're saying is that we have time to prepare for the storm. How should we prepare for the storm in our portfolios?
Yeah, and I think, Guy, we do have some time, and I've been like a broken record on this, and it's really holding cash to wait for valuations to break, and we're starting to see it in pockets of the public market. We're seeing it much more profoundly now, finally, in the private market. So I think having cash, clipping that coupon right now, and waiting to move in when these valuations break is what I would be doing.
Where in the equity market do you think you're being appropriately compensated for taking on this uncertain risk?
Well, it's coming in now.
Yeah.
I think there are certain software companies, I think there are certain business processing companies, Alex, that are pretty well positioned to take advantage of a softening in the US economy. On that business side, I'll give you a specific example, Workday. I think you and I talked about it before. I came in earlier this year. It had a weaker outlook announced yesterday than expected. But if you look at the macro trend, the white space is still there. It's still a pretty decent margin. The existing customer opportunity is huge. I liked it earlier this year. I like it even more now at these kinds of share prices. That's an example.
What do you think of consumer stock? Just how do you play the consumer story that you're talking about? Upper-end consumers have largely thus far been resilient from any notion of a downtrend. We are seeing trading down elsewhere. What would be the catalyst, do you think, to finally see that upper-end consumer start to come under serious pressure? You talk about the fact that maybe asset prices do crack. If the stock market cracks, does the high-end consumer crack?
Well, I'm going to have more insight on this actually in about 2 weeks from now, because I'm heading to Dubai to talk with some of the CEOs of the biggest department stores in the world who are targeting exactly that kind of consumer guy globally. One data point that I think is interesting that actually was discussed here in Bloomberg, you saw the CEO of Valentino come out and saying we're now seeing the luxury consumer starting to get more conservative in their spending. One thing I will say, guys, if you go back and look in history, in every downturn, even that top-end consumer has become more value-oriented. And we know that that middle-income consumer now is getting a lot tougher in reprioritizing its spend. I think certain retailers historically have benefited from that. Walmart being the number one, Target becoming Target being an example of that when there's been that mix shift in spending. So I think looking towards more value-oriented retail that's positioned to take market share is how I would play this one.
So Guy, I'm going to be going on this trip with Anne just as like a casual observer to be like, what is she seeing? And I can report back to you. But it does raise the question, Guy, sort of, we keep waiting for the consumer to tank, and then you get the consumer spending and income numbers, and they're still strong, and PCE prices are actually rolling over.
So there's a whole bunch of things going on here, clearly. The upper-end consumer still seems relatively resilient, which I think is a factor, and still has savings that are being held. I think it's the top 20% haven't burned through their savings. But elsewhere, I think in the income spectrum, the labour market, to Anne's point, is still holding in there. And I think if you have confidence that you are going to keep your job, you are willing to take on maybe a little bit more leverage, and that is consistent with maybe some of the data we're seeing in terms of borrowing. So maybe that's the narrative that we're looking at here. So back to Anne's point, maybe it does ultimately come back to the labour market. If that were to crack, that upends that whole theory.
So what is then resilient to that, Anne? Like, I understand that the luxury that you're talking about is one thing, but then do you go by Walmart? Is it like a Dollar Tree thing? Is it TJ Maxx? Like, is it a Target play? Like, how do you play the safety in that, I guess, is a good question.
Well, Walmart's a fascinating one, and you have been so patient with me on this show before, Alex. Like, come in and I talk about Walmart, and you've sort of suffered through it.
No, we like it. Go.
Here's the take. Let's pick on Walmart for right now. We know that it tends to get share of traffic gains in these downturns. We know that they've actively gone out to expand their offering. Right now, they've announced this. They're expanding into pet services. They're expanding into try and getting their fashion offering to be more broadly palatable. Here's the other thing that sits inside Walmart. A $2.7 billion plus revenue stream that comes from data-driven ads, where Walmart is mining its own data pools to try and build an ad and data business. That's the kind of play. So I'd be looking for these places that are more resilient with respect to the consumer, but where they're also reinvesting behind the future, which is in, for example, retail media.
And it's been great to catch up. I hope you get home safely. Thank you for joining us in the studio. We really appreciate it today. Yeah, definitely walking. Definitely walking. Could get help with wet feet at the other end of it. Anne Berry of Threadneedle, thank you very much indeed. I understand that Mayor Adams and the Governor are going to be holding a virtual briefing on the rain, 11 a.m. We'll bring you the details of that. This is Bloomberg.
For everyone watching the weather here in New York, I should point out that the MTA says service across networks severely disrupted due to rainfall. Now, if you live in New York, you know what that's really code for. The subways are not in good shape, is pretty much what that is saying, particularly if you live in Brooklyn. We're also waiting for 11 o'clock, where you have New York City Mayor Eric Adams and Governor Kathy Hochul will be doing a remote press conference for an update. Again, these are pictures from about 3 hours ago near my neighborhood, and I gotta say, Guy, it's a lot worse, particularly if you're in different areas of Brooklyn, like Gowanus.
So, Alec, you were showing me pictures earlier on. There's water coming through your ceiling, but you don't live at the top of the building. That can't be a good sign.
No, I know. Guy had to explain to me how something from the 7th floor can get to the 3rd floor and come. Yeah, my light fixtures apparently were leaking. My daughter's school, the bottom floor is flooding. It's a mess. This is not a good thing. Anyway, we're going to talk more about spending coming up next. This is Bloomberg. We're about an hour into a trading session. Volume holding up, considering that nothing in New York is because of the rain. But you're looking at the Nasdaq 100 up by about 0.8%. Abigail's tracking the moves. Abby?
Yeah, I'm getting a little bit nervous about how to make it home, Alex. Yeah. But stock investors, tech investors, they're pretty happy over the last 3 days. We're looking at something that we haven't seen for a while, and that is the Nasdaq 100 up 1.9% this end-of-month rally. We saw the same thing in August, because right up until the end of August had been on pace to be the worst month of the year, and then we had a month-end rally, and not so so much. But this rally is not big enough. August is still the worst month for at least the S&P 500 this year. As for the S&P 500, these are the worst sectors. So you can see why it's a brutal month for the S&P 500. At this point, I believe down about 5%, maybe a little bit more than 4%. Real estate, utilities, these rate-sensitive sectors, because their dividends look much less attractive when yields shoot higher. And then industrials and tech also in the mix. Energy is really one of the only sectors that truly outperformed on the month. As for those yields, let's take a look at what's going on. And this is pretty incredible. So we have this huge move higher down here, closer to like 1.4%, a move of over this time period of 3%. Right now we are at 4.52. And of course, Larry Fink and Bill Ackman saying we could go above 5%. You could use this whole area of congestion here and make the case that it's going to make an equal and opposite move to the upside coming off of here or here. That could actually equal 6%, which reminds me of Jamie Dimon's call for a possible Fed funds rate of 7%. So in any case, it does seem like yields higher for longer. Speaking of higher, take a look at Nike, up 8%, not so bad. The last time I looked, Guy, this was the best day of the year. And of course, inventories coming in, a better quarter than expected, and the CFO talking very positively about the guidance for the current quarter.
Yeah. They finally, it looks like, Abigail, maybe they're starting to get through some of this inventory issue that they've been battling with for so long. Obviously, inventory less profitable, the new stuff you're going to be selling more profitable. So let's talk more about what is happening with Nike's earnings and the consumer strength that maybe they're telling us about or not telling us about. Adrienne Yee, Barclays US Retail Senior Analyst, joining us now to discuss. She's got an overweight rating on Nike. It's kind of price target, though, from 124 to 119. Adrienne, great to see you on the show. Thank you very much indeed for joining us. Is Nike finally getting to grips with this inventory issue? Are we now behind, is the worst of it behind us?
The worst is now behind. If you remember this quarter last year, right, stock was kind of in a similar range, kind of broke that 90. And the issue, the new news at that point was that they had a flood of inventory that came onto the market. Kind of from, May into the September time period. They talked about selling 5 quarters worth of inventory within 4 quarters. And that's exactly what basically happened, right? Spring, summer, fall, winter, it all landed at the same time. Mm-hmm. And the clock started ticking now when they were kind of trying to get rid of it. I would say stocking, there's another word for stuffing, but stocking the wholesale channel there. And now we're basically on the other side of that. Mm-hmm. Wholesale destocking is just part of the cycle, the natural cycle of purging that inventory.
So, Adrienne, though, a year ago it was an inventory problem, right? But now the consumer could get pinched. We're waiting for that to happen, right? In terms of student loan repayments, et cetera. Now is it going to be a top-line problem?
Correct. We've transferred the risk from company-specific execution on the back of supply chain, some missteps, you could argue with their Vietnam production, et cetera, and working through these very controllable factors. So they've got a handle on sort of the things that they can control. Input costs are coming down. Inventory is getting better. Markdowns are being anniversaried. And we've sort of transferred that or shifted that into macro risk, right, both in the U.S. and then certainly in Greater China. Having said that, what we always say is when there's macro risk that's out of the control of the company, right, the things that they can control below the top line are really driving that visibility on earnings. And those are the companies that you want to be in because macro risks exist for everybody. So the relative outperformers are those who can control what's below the line.
So how does Nike fit into that? So if you are painting that kind of environment, the macro risk rises, it is a factor that all of these businesses are now going to have to deal with. Who comes up best? Who stacks up best in this kind of environment?
So you want to go with guys who have great balance sheets, a legacy of innovation, and frankly are big, right? So the brands, what happens with the consumer is the wallet tightens up. And whereas they may have been spending at 3 or 4 brands, they now spend at their top 2. Nike, Lulu, right? They get the share of wallet. Sometimes they get more of the share of wallet, right? Because you clamp down on that, but you're really kicking out anything that doesn't really kind of the mediocre brand to you. And so really you want to go with the guys who have the power. We've got a $4 billion demand creation budget, within that kind of P&L. that dwarfs some of the total sales of some of these nascent competitors that people always talk about.
So Adrienne, when we take a look though at, say, the personal spending and income that we got today, right? So income was still up 0.4%. Spending was up 0.4%. Do you believe these numbers? Like, is this really capturing what Adrienne captures over at Barclays?
So if you look at kind of sales momentum, right? So we look at this, the Red Book Index, and last year this time, the 9,000 stores that they track were up 11%. They're now up about 3.5%, 4%. So we actually have seen the consumer, quote unquote, pull back, right? Whatever it is, savings, depletion, et cetera. And yet they still are capable of generating, mid-single digit sales growth, which if you go back in history, that's about the range of retail sales growth, right? Low to mid-single digit. I think everybody's worried about the cliff, right? This kind of fourth quarter student loan and, ongoing, a number of other macro factors. But let's keep in mind, wage growth is now outstripping, right? We have real wage growth and people are unemployed. Guy, you mentioned this about in your other segment. That's huge, right? You tighten spending, you don't get rid of spending if you still have a job.
Yeah, and that's the critical factor. Therefore, we have to watch the labor market so carefully. Adrienne, how do people spend if we are going to see a slowdown? Does the dynamic of change, do we see a dynamic shift in how people go out and spend? Is it more online, more in stores, less in stores? How does that shift affect the different brands that we're looking at?
Yeah, that is a phenomenal question, because we always go back. We just did a big report on kind of what can we learn from the GFC, right? The last time we had a really major slowdown and consumption was really, really clamped. So first of all, mom and dad stopped spending. So sorry, Alex, but most of the time, right, you kind of like kick out the spending for mom and dad. They're not necessarily growing. Kids, teens, need-based discretionary. So we see some resiliency kind of in that piece of it. We also see bigger ticket. So you don't take as many vacations, but you reward yourselves with smaller transactional, goods. Apparel fits into that. Footwear would fit into that. Sub $200, sub $100 transactions. So there's clearly kind of a movement toward value. And in the other segment, we talked about kind of, Walmart, et cetera, kind of move to the discounters. But remember, value means price paid for quality received. So these off-prices are really kicking into gear, right? Mm-hmm. If you want to put new money to work today, you're going TJX and Ross, because that's where the consumer feels good about having spent less, but getting more.
Adrienne, yeah, it's true. I keep telling Guy I'm on a budget, and he keeps not believing me. Adrienne Yee of Barclays, thank you very much. I feel like I'm your weather update person now, but I think it's important. The NYPD is saying that now the B, W, and G lines are suspended in both directions. This comes after massive delays in the 1, 2, 3, 4, 5, 6, kind of in all directions there. We have a lot of delays there. Amtrak, Guy, services out of New York are experiencing delays. And when you get the headline of experiencing delays, you know it's going to be really bad.
I think you probably do have permission to go and buy a pair of boots. I think that is okay. You can break the budget today. A pair of Wellingtons looks like a really good idea.
Yeah, because, walking from the Brooklyn Bridge home is going to be like a little bit of swimming. So
those people there are going to, these people I'm looking at pictures of now, they are going to have soggy feet.
So that's in Gowanus off the F train, I think, right? If I'm thinking about that correctly. I mean, that is a nightmare. And that's not even like encapsulating a lot of the highways. Look at that.
That is, these pictures are actually quite incredible.
He's been making fun of me all day, but now he's taking me seriously a little bit.
No, of course I take, this is the weather. I take the weather very seriously. And that's a lot of weather. But what I find incredible is that this has been a year of a lot of weather. The fires and then this speaks to something.
It does. A changing climate. But to me more, it just speaks to how the climate, if it's more volatile, we just say volatile climate, you're not prepped for that in certain areas, as I keep saying. Like, you're prepped for something that maybe is changing what happens. As in, maybe you put solar panels on your house, but then all of a sudden it is not as sunny near your house anymore over the longer term. It's stuff like that I think is that a stroller? Oh my gosh. I just feel like we need some.
These are incredible pictures.
Yeah.
Is it going to stop raining at some point?
Okay, well, anecdotally, my husband has said the rain has lightened up. I mean, he's not a weather person, but it's supposed to rain all through Saturday. So there is that.
So that potentially, it comes with a lag. We talk about things working with a lag. This kind of weather works with a lag as well.
Yeah.
You can get flash floods and that happens, but the build-up obviously is incredible as well.
And it's been raining for like 4 or 5 days before this, so how to absorb it is even harder. Okay, anyway, man, there's a stroller. Okay, coming up, the Fed's higher for longer interest rates are hurting certain ETFs. We're going to get some details in today's ETF Friday. This is Bloomberg. Let's get to the markets. After a pretty tumultuous third quarter, the largest long-dated bond ETF is seeing its biggest drawdown on record as the Fed's higher for longer interest rates start to sting. Joining us now, Bloomberg's Emily Graffeo for today's ETF Friday. All right, Emily, what are you noticing?
So TLT, this is BlackRock's 20-plus year Treasury bond ETF. Like you said, record drawdown from its 2020 high. But what's interesting here is that investors are still allocating to TLT. We're seeing over $2 billion of flows into this fund. Just the other day, it had its biggest one-day inflow since July. Bloomberg Intelligence calls these investors duration addicts. So rates are going higher, most likely. Okay. The Fed talks about higher for longer, and yet people are still flowing into this long bond fund.
So are people shorting it therefore? There's got to be some people taking the other side of the trade.
That's a pretty good idea, Guy, because we are seeing short interest rise in TLT, so it's likely that some of those inflows that you're seeing on the chart are due to investors creating shares in order to lend them out to short. But still, we are seeing a lot of people still allocating.
Well, this was sort of my next question is like, how are people using them, right? Because if you're a long investor, why not go buy it and then get exposed to the duration for the long term, right? You're not doing it for any price appreciation in theory,
right?
Versus if you're a hedge fund, maybe you're using it to offset other positions.
I mean, some investors just need to get that bond allocation, despite the fact that they are seeing the price action fall. This is going to be the third year that we're on pace for bonds to drop. And at the beginning of the year, this was supposed to be the year of the bond, that people were really going to get that income, that bonds were going to play that diversification role in the portfolio. So a lot of those 60-40 managers that I spoke to in the beginning of the year said, yeah, we're really adding to bonds now, and they've been crushed yet again.
Emily, great stuff. Thank you for bringing it. We're going to watch this one. This is one of those kind of stories that you kind of see playing out in slow motion. Emily Grafeo, Bloomberg cross-asset reporter on what's happening with that ETF. Dianne Feinstein, the longest-serving female U.S. senator, has sadly died at the age of 90. Bloomberg's Kelly Lyons is on Capitol Hill. This is one of those moments when you think, Kaylee, about the history of women on Capitol Hill and how it started. And she was there, and that's the point, isn't it? I think somebody was telling me earlier that she was the second female in the Senate. That is incredible.
Yeah, she was elected, Guy, in 1992, a year that was dubbed the Year of the Woman, in part because women like her arrived here on Capitol Hill. As you say, she served here for more than 30 years. You can see the flags at half-mast on the Capitol behind me. It is the same in the surrounding buildings, as everyone here reflects on the legacy of the senator. She, of course, was very powerful. She served as the chair of the Intelligence Committee, also on the powerful Judiciary Committee. She was up front in certain issues, including national security as well as gun control. She authored the assault weapons ban of 1994, but her passing also leaves a lot of questions here at the Capitol. This is now a seat that is vacant. She was supposed to be serving in it until January of 2025, and it will now leave Governor Gavin Newsom to appoint someone to that seat in the interim, remembering that there is a primary battle for her seat ongoing between three Democratic members of Congress, Katie Porter, Adam Schiff, and Barbara Lee, and Governor Newsom has said that he would appoint a black woman to that seat. So that is what the questions are to come. But for now, everyone reflecting on the senator's legacy after her passing at 90 years old.
And from my memory, President Biden will be speaking also on this. What do we expect there, Kaylee?
Well, we will likely expect the president to honor that legacy. The White House sent out a statement earlier talking about what the senator had accomplished and how she was a trailblazer for women, not just in the Senate, but in Congress more largely, remembering that this is one of the longest serving senators in U.S. history we are talking about. I would also note, guys, the last vote that Senator Feinstein cast was yesterday morning, and it was a vote to advance a bill to keep the U.S. government open.
Kaylee, thank you very much indeed. Kelly Lyons joining us with the sad news from Capitol Hill. We will continue to track, obviously, events on Capitol Hill. This as we lurch towards what increasingly appears to be that inevitable shutdown. The real question, I think, from the market's point of view is, when does that become real? Is it Monday morning? Is that when this story starts to really kind of work its way onto Wall Street? Talking of Wall Street, we're going to have more on what is happening on Wall Street next. Jane Frazier's downsizing plans certainly front and center right now. We'll have more on that story next. This is Bloomberg.
in many areas you may need a recession to bring down labor demand. And I think this is one of the things that's going to impact in the United States. You still have a very vibrant economy. The United States, as I said, the J curve of the Infrastructure Act, the CHIPS Act, the IRA, which has huge implications, that's going to be creating jobs. And so it may require a more protracted Federal Reserve, and it may mean by 2025 the United States economy may be entering a recession, but I don't see it any time in the near term.
That was BlackRock CEO Larry Fink speaking with Bloomberg's Danny Berger. So let's stay on the Wall Street field. It's time for Wall Street Beat. We take a look at what's buzzing on Wall Street and the world of banking and finance. And today we're going to take a look at Citi and its downsizing plans. Joining us now to break it down is Bloomberg's Jenny Serrain. All right, what do we know so far?
Yeah, so about 2 weeks ago, Jane Fraser laid out what is supposed to be the biggest restructuring of Citigroup in the last 2 decades. And so you really have her trying to convince investors that this is going to be putting the company on a path towards more profitability, better returns, really getting it in line with peers. They've just really long lagged all their rivals, and so she's got a bit of a turnaround job ahead of her still to come, but that is what they've been working on, and they have until the end of November to really come up with those firm plans for how they're going to carry this out.
Jennifer, she said the other day, I think, you're either on the train or you're off the train. Now, a bunch of people have already been pushed off the train. Are we going to be seeing more people feeling that same fate as well? Headcount, how much is it going to come down?
Yeah, so I think what this move is really about is kind of getting rid of the layers of management that Citigroup has